India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Tuesday morning, we're coming to you live as always from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Survi. Guys, hi, good morning.
Hi, morning. So, second day of the week. The week started off on a pretty decent note.
Yeah.
And I guess the bulls will really hope they can kind of build on. We don't have too many bad global cues, actually. The world's a pretty settled place this morning, right?
Well, that's right. And the key constituent performed yesterday, the Nifty bank. So, hopefully that continues its good performance.
I mean, oil is down. US equities are higher. Bond markets were out of the picture. So, I think it's not a bad sort of backdrop. It's not been a bad backdrop. And, that's the point. You could have there are lots of reasons to be slightly held back as far as India is concerned, and those reasons are perfectly valid. But the fact is, local flows have been strong, and globally, US is doing well. China incrementally is expected to do well. So those are the two big drivers for global growth, and they're looking just fine, even as we run into a bunch of events like elections, etc. But let's talk day to day. And tell you what you need to know. So, US equity markets, another new high, all-time high, and Nasdaq was up about 0.8, S&P was up 0.77. So it's a new record high, and on the S&P, you're looking at what, 6,000 by the end of the year? We'll see. But it's been a pretty strong run. US bond markets were shut, so no cues out of there. In terms of yields, etc. Oil prices are the other big change, which I think stand out. 3% cut, and this is on the back of some perceived reduction in geopolitical risk. So this is a Washington Post news report, which essentially says, without sort of naming sources or who their sources are or who they spoke with, basically it says that Israeli Prime Minister Benjamin Netanyahu spoke with the Biden administration officials, and he said that they will strike Iran, which of course they promised to do, but they will they'll avoid striking Iranian oil and nuclear facilities and concentrate on military targets. So this is, I think, what has taken that 3% out of oil prices. Remember, a lot of the oil premium, the rise that we had seen was built on the assumption, of course, first, the promise of retaliation that is coming, and of course, fears, and there were some news reports earlier which suggested that they may actually consider striking some of these oil facilities or even some of the nuclear facilities, etc. So this is, I think, the news item which has driven the price of oil lower. Dollar index was slightly higher. We're at about 103.2. So at the margin, slightly negative in that sense. But we saw a nice breakout yesterday, and I think that's a starting point. So we finally managed to have a decent close above the 40-hourly exponential average on the Nifty. And that kind of gives, at least in the very near term, upper hand to the bulls. So now we're looking at retracement targets, 25,485, which is the 50% retracement of the entire fall, and 25,672, which is the 61.8%. So if these levels hold, if the short-term, very short-term averages hold, you're essentially looking at a slow rise all the way to these. Bank Nifty also closed decisively above the 40-hourly exponential, and it managed to take out the previous high as well. Here again, 50 and the 61.8% retracements. The numbers don't change. 52,330 and then 52,835 are those levels that you're looking on the upside. And on the way down, yesterday's low, which is 51,005, should be protected and should not come into view. For the Nifty, of course, it's last week's low that we had seen, but we've quickly put some distance. So I didn't mention that on the downside. The environment, the backdrop, once again this morning is, the global backdrop especially is a little better. Lots of earnings to react to, and will that take a bite? Will that bite? That's the question. The big one, Reliance at the margin, perhaps has not done all that well. Some of the seasonal slowdown or whatever. So we'll have to see. That's a big name and has an outsized influence on what the indices do. GIFT Nifty will come up on your screen. That's indicating a 18, 19-point higher start. Surabhi.
Oh, yeah, absolutely. Slightly mixed picture across Asia. The GIFT Nifty is picking on the markets that are doing well, which is, Japan's come back after a break. The Chinese markets and the Hong Kong markets, they are flashing a little bit of red at this point in time. Taiwan's doing better. So it's a fairly mixed picture. On oil, just to add to the point that Prashant made, that obviously geopolitics is top of mind, and that's why we're seeing prices do what they do. This drop of almost 3%. In addition, OPEC is saying the world will probably need lesser oil than it previously thought. So they've cut down the demand estimate, not just for this calendar year, but for the next one as well. So 2024, they were earlier on the expectations of 2 million barrels a day. Now it's 1.9. For 2025, it's come down from 1.7 to 1.6 million barrels a day. So generally, the anticipation is that there'll be lesser demand unless something major happens in China and that economy starts going into an overdrive. So that's on oil. Just to talk about, of course, the inflation picture here, since we're talking oil, and oil is clearly not the problem. It's not about fuel. It's not about the WPI, but the CPI numbers were uglier than what one had anticipated. That's the issue. The number came in at almost 5.5%, which is obviously above the RBI's comfort zone. And look at food inflation. I mean, month on month in September, it spiked to over 9%. And within that, look at vegetables. And these things, the RBI watches, the governor's made it a point to sort of talk about the importance of looking at food inflation and not ignoring it. Though, of course, economists do say this is probably transient and was expected to, show up in this way. But 36% vegetable inflation. So that's a bit of a negative. What is positive is the fund flow picture for the market, because the FPI selling intensity that has continued to decrease. And now after many, many days, we're looking at a net sell, but less than 4,000 crores. And domestic institutions obviously are providing the cushion on the other side. They didn't buy too much yesterday, but still about 2,200 crores. They continue to chip in there. So that's a good thing for the market, that the cash market FPI selling intensity is reducing. Coming to the earnings that Prashant spoke of, Reliance, well, it depends on how you cut it up, but the best thing in the numbers really has been Jio. Jio has sizzled away with an ARPU increase of over 7%. That ARPU number is now touching 195. The retail business has shown slightly soft trends. The revenue growth hasn't taken off for Reliance Retail that much. The oil and gas performance is better than expected, but if you see oil to chemicals, there's some pressure at the EBITDA line over there, and we'll talk more about it as we go forward. But net, I think that Jio headline is the one that the market will really want to run with. HCL Tech, another blockbuster show, and fantastic, because not only is the constant currency growth better than expectations at 1.6%, they've increased the guidance, at least the lower end of the guidance. The new band now is 3.5% to 5% versus 3 to 5% earlier. So we've got some positive cues coming in over there. And then, of course, lots of mid-cap earnings. We'll get to them as we go along. And let's not forget, today we get our biggest IPO ever, the newest biggest IPO. Hyundai opens out for subscriptions today. It's a big, big issue, right? And that's one of the concerns in the market, that as the company raises well over 27,800 crore rupees, and that liquidity will be mopped up. So could that put some near-term pressure or not? You'll hear a lot more about Hyundai as we go forward, but that's the big one to watch out for. Nigel.
Well, in terms of all the market cues that are stated, the crude oil price drop, that's something that's encouraging, right?
Yeah.
OPEC demand is lower, that's good. But I think what Prashant said, the de-escalation of tensions, that's good for the market, yes, but it's good for mankind as well. And you like to wake up to news like that. So the big cues that came in overnight was that crude oil prices are lower by close to around 3% odd. That somehow gets nullified because the dollar index is stronger. It's holding at around 103 odd. And, normally when you see the dollar index strengthening, it has an inverse relation with what happens with metals. So let's see whether or not metals comes in under pressure, because when it was weakening, we did see a good run on metal stocks as well. So we'll keep an eye out on that. Yesterday's trading session was good, actually. The Nifty bank did outperform, and that was because there was a bit of a short covering bounce that did play out in yesterday's trading session. It appears the shorts were mostly covered on the Nifty bank. Now, the FI positioning, well, they lightened their positions on both sides, long as well as on the short side. And now they continue to remain net short with close to around 65% of their positioning on the short side. In absolute terms, the FIs and the clients, well, they're on opposite ends of the spectrum. The FIs are net short, while the clients, well, they are net short at around 1.9 lakh contracts odd. But the Nifty bank, that's the one that needs to drive us higher from here, because you're getting stability coming in from the IT index. But the Nifty bank will have to drive us in higher. And yesterday was particularly a good session. I say that because we went to this mark, right, of around 51,500, 51,700 odd. But yesterday we managed to end closer to the high point of the day. On the previous occasions in the last week or so, well, we did see profit taking. So yesterday was a good session, and we ended at the highest point we have seen all the way since October 3rd. So good going out there. But the driver for the Nifty bank was HDFC Bank. And in yesterday's trade, it's taken out the 50 DMA. Now it's very, very close to the 20 DMA. So in terms of a technical level, you wanted to get past that 1700 mark and you wanted to trade out there. If HDFC Bank can conquer that 20-day MA, it's conquered all the key technical levels, and then it could be good for more, which in turn helps the Nifty Bank as well as the Nifty as well. The other big index that we look out today is the Nifty Financial Services Index. It's a Tuesday, so it'll play out the weekly expiry. Reliance Industries, what do you do with that one? Remember, it's corrected close to around 14% odd, and Jefferies came out with a very interesting note. They say post this correction, well, it already has discounted the print, the weak print that we've seen in the past quarter. And they make this point on valuations. In the last 5 years, when the stock has traded at these valuations, investors normally make money. So we'll have to see whether or not that plays out yet again. So that's going to be the important stock to move as well. But on a technical basis, it needs to get past the 2,900 mark to be good for more. But fundamentally, things are looking up. Let's wind this down with the Nifty levels then. The recent high becomes a bit of a resistance. 25,250, 25,250 to around 25,300. That becomes a bit of a resistance mark, while you have your reference point on the down end at around that 24,700 mark. So let's see how things move from here.
All right, Nigel, thanks very much for that. So we'll keep an eye out on some of these stocks and, of course, talk about the sort of the drop in the oil price of oil as well. We have Marco Papik, Chief Strategist at BCA Research, joining us to talk to us about markets. Marco, great to have you with us here. Thank you very much. Appreciate it. So let's just start with that 3% drop in the price of oil that we've seen. That Washington Post report, which kind of has lowered tensions a little bit. What do you make of it? And do you think the drop is going to endure? Or should we be prepared for the eventual strike which will come and then the markets will react? What's the sense?
Well, I think one thing that has changed over the past 12 months has nothing to do really with geopolitics. It's the macro context. And what I mean by that is that the Fed is front-loading quite a bit of cuts, and China has hinted at some fiscal support for its economy, although it hasn't really given us much to work with. So the reason I start with this is that if you look at price action for oil over the last 12 months, almost every time there was a geopolitically induced rise in prices, it was really an opportunity to fade, to short the increase. However, I think that the Fed and Beijing actions over the past several weeks do create more of a sustainable, bullish environment for oil over the next 3 to 6 months. And so that's the first issue. The second issue is your point about geopolitics itself. I do think it's getting a little bit more complicated. First of all, the US election will end, in 3 weeks, or at least I guess we hope so. And the reason that that's important is because no matter who wins the US election, they're going to have to deal with the fact that Iran's stockpile of highly enriched uranium is double what it was in 2011 when the US threatened to attack Iran. So forget Israel for a second, forget war between Israel, Hamas, and Hezbollah. Even if there had never been that October 7 Hamas attack against Israel, we would still be talking about what happens to the Iran-US relationship after the election. And I think that also supports oil prices a little bit more sustainably than what's happened over the last 12 months.
Yeah, absolutely. Take that point, Marco. We have a lot going on, and with US elections, it's really going down to the wire, right? By the way, guys, I don't know if you saw Kamala Harris releasing a plan for black men in America, something called forgivable loans, where I don't know if that really means that there'll be a waiver on interest, but some kind of sort of big plan to bring in the that segment of the population and to sort of swing those votes specifically targeted at black men. And they're looking at maybe she went ahead to talk about making perhaps cannabis illegal, legalizing marijuana. So yeah, it's all going on in the US election. Take that point, Marco. Let's talk markets. So given that we live in a very, very conflicted and very complex world right now, in terms of market bets, what would your key longs be? Between, let's say, oil or US equities, emerging market equities, what are you trading long right now?
Well, what I would say is that I really like the setup for Japanese equities. I also think that European equities could outperform the US over the next 12 months. Generally speaking, I'm much more constructive on risk than I think many other investors, even with S&P 500 approaching 6,000. The one risk, however, in the US is that if Donald Trump wins the election, there is a chance that the bond market reacts negatively, which could create some indigestion right after the election. Now this happened in 2016, but nobody remembers it. Bonds actually sold off pretty aggressively, but US equities did extremely well. But that's because it was 2016. The world needed growth, the world needed inflation, and so bonds and equities were negatively correlated at the time. In 2024, I'm not sure that the world needs either more growth or more inflation. And so the risk of a Trump presidency, because it's accompanied with this pretty clear control of Congress, would be that the bond market could have some indigestion. So investors should seek some safety in non-US equities.
Interesting. Hi, Marco. Good morning and good to see you in. Nigel on this side. Marco, what about emerging markets, and particularly a market like India? You've given us a brief take on China and how things are shaping up out there. But India has been the big outperformer, political stability, earnings growth as well. But valuations have been a bit of a headwind. What kind of allocation do you think comes to India?
Well, I think in absolute terms, India can do well as well. The valuation is an issue, and it's not really a problem when the cheaper segments of emerging markets are doing poorly. Then you just buy what's expensive because it's value. I mean, it's expensive for a reason, as people would say. But when you start seeing a little bit of movement in the rest of the world in terms of stimulus or policy changes, that's when valuation becomes a problem. And so that's why what happens in Beijing is more important to India than almost anything that happens in India. And what I mean by that is that if the fiscal policy rumors are true, and if Chinese policymakers actually do something about it, Chinese stock is just priced for imperfection. In other words, policymakers don't have to come out with a clear, perfect plan. They're just so cheap that almost anything will set that flame afire, whereas India is priced for perfection, continued perfection, and that's more of a difficult, story to continue. And so I think a lot of global allocators might start looking to trim their exposure to India and pick up some of that value in China.
No, absolutely. Got that. By the way, the latest sort of betting odds show that Trump is ahead once again, right? I mean, the momentum has shifted back to him.
Yes, absolutely. Well, in fact, the whole point that Kamala Harris, who is an African-American woman, is, this late in her campaign proposing an economic plan for African-American men suggests that there is a little bit of a panic in the Democratic Party with some key constituencies that tend to vote for Democrats. And so, we already know this is public information from the polls, that Kamala Harris is doing pretty poorly with some of those key demographics. And so it's really revealing a level of concern. And the reason for that is that if you look at the swing state polls, both of the candidates are pretty much tied neck and neck, in almost every swing state. The problem is that both Clinton in 2016 and Biden in 2020 had a pretty robust lead on Trump in those swing states. Of course, that didn't help Clinton. But the point that I'm making is that Harris has no slack in the swing states. And that's been the case for a long time. It's been the case for a month and a half now. And without slack, it's not clear to me how Harris can really pull out a victory. So yeah, I would agree with some of the betting markets. It's not a high conviction view. They are still pretty much in a statistical tie in national polls. Harris is actually much higher there than in the swing states. So it is a close election, but I would say that Trump probably deserves a 55-60% probability at this point in the race.
All right. And 20 days to go, right? 22 days to go to the US election. Marco, great to have you with us here. Thank you very much for your time. It's always a pleasure, and looking forward to our next conversation. Well, we'll take a quick break, but just running you through the stocks that you'll hear about with our research team in our top 10 segment on the other side. Reliance Industries, HCL Tech, Angel One, Suntech Realty, Honeywell Auto, GIC RE, Ramratna Wires, and CESC are the stocks which are on the radar on the back of positive news flow. Gopal Snacks is the only one which has got some negative news flow. Crude sensitives may also open under pressure. Of course, different kind of reactions to oil marketing companies and oil producers on the other side. Let me also quickly run you through the corporate interactions which are lined up on the show. So 8:35 today, we have Naveen Kulkarni of Axis Securities PMS joining in. Prabal Sen of ICICI Securities joins in to talk about the Reliance numbers. 9 o'clock, you'll hear from Jai Kale of Elara Capital, Hyundai Motor IPO, the largest ever opening. 9:20, Rahul Arora of Nirmal Bang talks markets. 9:30, we have C. Vijay Kumar and Shiv Valia of HCL Tech to talk about their earnings for the second quarter. Tarun Garg of Hyundai Motor will, of course, talk to us about why and make the case as to why you should subscribe to that IPO, the Hyundai IPO. And it's the economy at 10:15. Lata will be speaking with Shashadri Sen of MK Global to discuss if weak macro trends in the second quarter will impact earnings. Right, it's time for a quick commercial break here. A list of top stocks to watch lined up next. Stay tuned.
Welcome back. So the hope and expectation is that we'll start off on the positive side. At least that's what the implied open has been indicating. And there's a bit of green across some Asian markets at least. Let's talk about stocks because it's earnings season full bloom and there are plenty of numbers to go over. Our team is standing by to take you through the CNBC-TV18 list of top stocks to watch for the morning. Guys, morning to all of you. Let's start off with the biggie, Reliance itself. Sonal, tell us all the details in the different businesses.
Well, it was a steady set this time around, Surbhi. If we talk about the revenues, absolutely flat at 2.32 lakh crore rupees, but profits, they came in higher than what the street was working with, came in at 16,563 crore rupees. What did well? It was Jio which supported earnings this time around, led by higher tariff hikes. Full effect of tariff hikes came in this quarter. Profits were up 23%. The oil and gas EBITDA margins also were very strong, came in at 85% versus 72% on a YOY basis. Retail margins slightly saw a better number. However, the growth slowed down here, but the outlook is positive. The O2C business margin, that was under pressure because of the demand-supply situation that we've been seeing globally, and that is the reason why we saw lower margins here. Now, brokerages, they mostly have a buy call on the stock. Jefferies has a target of 3,400 rupees a share. Morgan Stanley has an overweight call with a target of 33.25. They say Q2 EBITDA versus their estimates missed because of weak domestic demand, but profits beat estimates for them this time around. Nomura also has a buy call with a target price of 3,450 on the stock.
All right, Sonal, thank you very much for that. So that's the big one today that will be in focus. HCL Tech is the next one we want to focus on. Came out with second quarter earnings. Rima is here with details. Rima, morning.
Strong set of numbers from HCL Tech in the second quarter. A revenue beat. The company's constant currency revenue growth has gone up by 1.6%, surpassing street expectation. Margin expansion stands at 150 basis points at 18.6%. This is higher than what the street was anticipating. And the company said that they are seeing improving demand incrementally across various verticals. So BFSI has done very well for them. And therefore, the company has raised the lower end of the FY25 guidance. So the earlier revenue guidance was 3 to 5%. It now stands at 3.5 to 5%. Nomura, Morgan Stanley, bullish on HCL Tech. They've gone ahead and raised the target price. There are EPS upgrades too. But HSBC and Jefferies have a hold rating. So HSBC says valuations are now in line with TCS, which restricts further re-rating. And Jefferies says they also see limited scope for a re-rating. So their target price stays at 1770.
All right, Rima, thank you very much for that. Actually, you'll hear from the management of HCL Tech in a short while from now. So C. Vijay Kumar and Shiv Walia join us at 9:30 to talk about those numbers. Let's talk about capital market plays, right? Angel One reported second quarter numbers. Vamakshi is here to detail that out for us. Vamakshi, morning.
Well, good morning, Prashant. Angel One reported a strong set coming in this time around, especially on the operational performance front. Revenue for the company stood at 1,515 crores. This is an uptick of almost 8% sequentially, largely being driven by an uptick in the interest income, which was up nearly 22% quarter on quarter. When we look at the operational performance, that seems much better, and that is because in the first quarter, we had IPL-related costs of somewhere around 115 odd crores, which are not there in quarter two. So therefore, we are seeing a very sharp improvement. The cost-to-income ratio too has reduced from somewhere around 64% to 52.3%, and resultantly the margins are seeing a very sharp improvement, almost from 33.5% to 44.4%. Resultantly, net profit has also seen an uptick of almost 45% sequentially. This has come in much higher than what the street was working with. A con call is scheduled today at around 11 a.m. We will be watching by for the commentary that comes through from the management, especially regarding the stricter F&O norms, the impact on volumes, as well as the mitigation measures that they will take to mitigate these risks. So overall, when you look at Angel One, it's a slight miss on revenues, but the operational performance more than makes up for it, going with the green for this counter.
All right, Vamakshi, thanks a lot for giving us a quick analysis. Well, let's go hop back across to Sonal. She's tracking Gopal Snacks as well as Sunteck Realty. Sonal?
Well, let me start with Gopal Snacks, tracking it on the back of Q2 performance, which was soft operationally. If you talk about the margins, they declined on a YOY basis to come in at 11.2%, 11.6% versus 12.7%. Profit growth has just been at around 6%. If we talk about the internals, in the two segments, the Ghatia segment has not done so well. At least the growth is slower than the other segment, where revenue growth has been 13.5%, volume growth has been around 16%. But for the wafers business on a low base, it's a strong growth, 46% in terms of revenue. Volumes are up 40%. For Suntech Realty, it was a good operational update. While the other players have been seeing a YOY decline, this company has seen a 33% increase in pre-sales and 25% increase in collections. So looking good for Suntech.
All right, we'll keep them on our radar as well. Sonal, thanks for that. Let's go back to Vamakshi. She's looking at some more names in the mid-cap space. So which are these stocks, Vamakshi?
Well, good morning, Surbi. I'm looking at Honeywell Automation. The company has secured a contract to provide its airfield ground lighting system for the Noida International Airport. Apart from that, keep an eye out on GIC RE going with the green for this counter as well, and that is because credit rating agency AM Best has upgraded the financial strength rating to A+, which is A-, which is considered excellent, from B++, which is considered good. They've upgraded the long-term issuer credit rating to A- from BBB+, and AM Best has also revised the credit rating outlook to stable from positive. CESC is the next one I'm watching out for, going with the green because its arm Purva Green Power will be acquiring 100% stake in Deshat Solar Energy. Keep in mind that Deshat Solar is engaged in developing solar PV power plant of nearly 300 megawatt capacity in India. This in turn will lead to expansion of the company's renewable energy business. So on the count of that development, going with the green for CESC. And lastly, let's also focus in on Ramratna Wires. They've approved an acquisition of 60% stake in Tefabo product, and this is for a cash consideration of around 30 crores, which puts the price to sales ratio at 0.8 times. Tefabo manufactures fabricated components and assemblies. It has a very strong presence in renewable energy sector, and many MNCs are already on board as the company's client. So bodes well for Ramratna Wires, going with the green for this counter.
All right, Vamakshi, thank you very much for that. So lots of names with specific news items which we will pay attention to at 9:15 as markets open. Now, oil should be in focus. That's a big one from a macro perspective. 3% cut. Manisha is here to detail that out for us. Manisha, morning.
Hi, morning. Thank you for that, Prashant. Well, yes, it has been a good gain, rather good loss for the crude oil prices. We have seen 2.5% of a decline come in for this one. Well, 3 or 4 factors for this. One, the OPEC has cut the world demand estimates for 2024 and 25 as well. So for this year, now the incremental growth is seen at 1.93 million barrels per day. Almost all other agencies had cut the demand estimates, barring OPEC, which also has come on board now. The second point is the weak Chinese demand and the lack of any new major stimulus that the street was anticipating over the weekend. Well, that reaction came in on Monday and overnight as well. The third is that Israel says that as they strike Iran, it would only be Iran military and not the nuclear or the oil facility targets. Now, that has taken a bit of a war premium off the prices also. There are various reports suggesting now that fourth quarter, if there is no escalation, that the crude oil prices can come down all the way down to 75, which we're trading right now, and all the levels, to a level of 72 to 70 on the lower side as well. But if there is escalation, then from Bernstein to Citi to Bank of America are not ruling out $100 on the higher side as well. So for this quarter, it's a very, very big range that these banks and brokerages are playing with in sense of crude oil.
Okay, all right. Thanks for that, Manisha. We'll watch out for a lot of the crude oil sensitive stocks as well in trade today. Let's quickly recap our list of stocks to watch. The ones that have positive news flow are Reliance Industries, HCL Tech, Angel One, Suntech Realty, Honeywell Auto, GIC RE, Ramratna Wire, and CESC. Gopal Snacks, this is the only stock really that may open out in the red on the back of numbers. And then, of course, we'll keep all the crude sensitives like tire companies, paint companies, and, of course, oil marketing companies on our radar as well. Quick break on that note. We'll come back on the other side and connect with Evan Choksi of DR Choksi FinServe and get some fundamental stock analysis going.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a great morning. Well, to help you out with some fundamental analysis, Deven Choksi, MD at DR Choksi FinServ, joins us on the show. Hi, Deven. Good morning. We'll get to Reliance in just a bit, but I wanted to ask you about HCL Tech. You know, the numbers look pretty okay. The problem is that the stock is trading at premium multiples in comparison to its averages. And now it's trading closer to Infosys as well as TCS, which is something we haven't seen in the last many years. Your view on the stock at current levels, and what do you like from the tech pecking order, if you could give us?
Hey, Nigel. Good morning. Well, certainly the numbers are more or less in line with expectations from HCL Tech. And if you go past, I think, some previous quarters, I think the indications were very obvious and clear for the new contracts that they've been winning. The most important part of the commentary in those contracts, they have been talking about the margin accretive businesses. So from a perspective of looking at the validation today in this result, I think you find that the commentary has played out, which was made in previous quarters, about, I think, the growth in the business along with the margin acquisition. And at the same time, we are also seeing the growth continuing in the current financial year as well as next. So from that perspective, the visibility is far more clear. Management, I think, commentary is also far more confident. And that's where probably, I think, higher amount of allocation of money has happened in this particular stock. Maybe I think everything is priced in at this point of time. May not be seeing, I think, a very large upside, but quite possible that I think if you see the sector rotation or the stock rotation within that, then possibly I think the stock might find it will favor. It may not go down in hurry at the same time. So probably I think any correction in the stock price after the result that could invite some more entry of the funds into the stock in the investment portfolio.
Okay, that's as far as HCL Tech goes. Deven, hi, morning. Reliance Industries itself, and of course, we have to break it up and discuss it in at least three different parts, right? I want to start with the retail operations and what you thought of the slight softness that we had there. The top line growth was not as fired up ahead of the festive season as one would have thought. So do you think this is just a temporary lull? What did you think of Reliance Retail first up?
Yes, Sylvie, good morning. Well, maybe I think you may call it as a partly an impact of the quarter, or partly you may also want to call it as an impact of some amount of consolidations that they are doing in their operations. The best part out there, I think, that is a validation of this viewpoint, that the EBITDA margin has been improving very systematically. About 8.8, 8.9% kind of EBITDA margin that they are being reporting, as against the previous year, I think, which was somewhere around 7.5%. So systematically, if you look at the vertical-wise retail, probably they are weeding out some of the lesser profitable businesses and putting more emphasis on the larger amount of margins which are being generated from likes of electronics. The fashion and lifestyle part of the business, I think, is remaining slightly under pressure. Maybe it's slightly temporary. Maybe it's that slightly changing the format. They are adding the youth format in this particular segment. Seeing the success of video, I believe that I think they are probably adding and catching up with the youth format. So maybe I think in subsequent quarters you might see the fashion and lifestyle also catching up. The grocery part of the business, I think, is remaining slightly muted, largely the impact of the quick commerce, which also, I guess, I think they're trying to cover it up through their own GeoMart stores. So maybe this quarter can be, I think, a one-off. Maybe I think one could see relatively better performance, seeing the consolidation which is happening, and particularly more because of the new brands which they are bringing on their own. That is assuring that they will have the margins protected in the business.
By the way, there was this news item on Viatech Vabag, which was flashing. There was 1,000 crore order, or around 1,000 crore order, which was flashing. Stock was up sharply after. I mean, it's kind of gone sideways for many weeks now. But 7% pop yesterday, and it's closer to 1,700. Devin, any thoughts? Have you guys looked at this one closely? Not the order, but the company per se. Yeah.
Yeah, Prashant, may not have seen the order per se, but I think over the last few quarters, once again, this particular company is largely thriving on the new orders, largely because of the infrastructure spend which has been incurred in the country and the waterways in which this particular money is being spent. I think where this company is significantly more prominent player. So that is where they are winning the contracts in every successive quarters of a larger size. But I'm very careful about one aspect, that these contracts do take longer time to get executed. And that's where probably I think you will find that the immediate reflection in the working of the company may not be seen at a larger level. At the same time, I think the business becomes extremely working capital intensive at one point of time. Having seen, I think, the larger amount of execution, the collection of money takes its own time. So all in all put together, I believe that I think this particular business, if it is trading at a significantly high premium, then probably one will have to be a little bit more careful about. No doubt the prospects are bright, but the valuations are pricing in everything at this point of time.
Okay, all right. Deven, let's finally ask you about the banking names as well. And HDFC Bank, yesterday it was the big driver in trade. Technically, it's very close to its 20-day MA, but fundamentally closer to around 1,700 rupees. What's the view? Do you think its time has come to give up its underperformance?
Yes, I would think so, Nigel, because for 2-3 points. On one side, the size of the balance sheet is definitely, I think, making a case for the larger amount of participation into the expansion of the AUM that this company can have. The larger projects definitely demand larger institutions to support them, and that's where HDFC, SBI, kind of larger banks, I think, will figure in. In my viewpoint, I think they could continue to grow the size of the business along with the housing finance portfolio in the vicinity of around 18%, 17 to 18% AUM book size. So that is where probably I think the opportunity size is big. On a size of 25 lakh crore AUM, I think it's a big opportunity size. I think that we are talking about. On the other side, the valuations are not far expensive, and that is where probably see contra buying opportunity also happens, I think, in some of the funds. In my viewpoint, I think since this stock has been a little underinvested by most of the funds, probably this contra buying opportunity is being seized in right now, and that's where we are seeing the re-rating in the stock. We would remain positive about the possibilities. And as I maintained in past, I think should they show some kind of a signs with the fintech platform that they will get in, probably the retail part of the business, I think, could really spring up very well. So one will have to look at this part of the possibilities eventually.
Deven, I'll just go back to Reliance to now complete the overall picture, right? The sum of the parts. You expressed the views on retail earlier. Jio, of course, has been a stunner this quarter, right? With this 7.4% ARPU growth. Oil to chemicals is slightly mixed. So what's the overall takeaway? The stock has cooled off 15% from the highs. I mean, tactical reasons, FPI selling. I think there's just a lot going on over there. But what would the advice be on Reliance now? What do you expect, say, over the next 6 to 12 months?
Consumer-facing business is both retail as well as Jio platform, the digital business. I think they remain absolutely very, very strong and convincing. On one side, you have got the customer base, which is 47, 48 crore customers. On the other side, I think you also have the contributing customers, which is, I think, significantly increasing. Increasing the ARPU is helping them. Jio Fiber, the connectivity with home is definitely adding more to that particular possibility. In my viewpoint, I think the amount of implementation of AI that they are having across different user verticals, be it education to agriculture to healthcare to fintech or even e-commerce, I would think that I think this company is talking about phenomenal amount of platform as a service provider kind of a business going forward in the digital space. So from a perspective of looking at this business, I think they are not only showing the sustainability and the growth, but also showing a big, significantly large amount of growth and the promises. Today, I think if they are growing at around 16-17% or 17.5%, I would think that I think 20% kind of a growth rate in the profits could possibly be possible, possibly I think materialize in coming quarters also. So one remains, I think, distinctly positive about Jio platform, its prospects in the entire portfolio of Reliance.
All right, Deven, stay with us. We're going to come back to you in just a bit. But Anuj is here now to take us through what he's making of the trade setup. Anuj, good morning.
Morning, Prashant. And the market's at quite a bit of inflection point. Look at what Nifty and Bank Nifty did yesterday. The Nifty first, and you would notice that after 3 days of lower high, the Nifty made a higher high, 25,159. And not just that, it closed at almost the highest point of the day, which is something the Nifty was not able to do because it's always tough to carry overnight positions in a market like this. The Bank Nifty is even more pronounced. Here also, if you see the chart of the last few days, the lower highs, but yesterday, not just a higher high, but the market or the index almost closing there. That's a good sign. In fact, not just that, it's the best closing for both Nifty and Bank Nifty since the correction started, dating all the way back to the October 3rd. and Nifty and Bank Nifty both are now 150 points away from the 20-day exponential moving average, which is the most important tool as far as the near-term trading direction of an index is concerned. Because if you don't stop at 20-day mark, then there's a possibility of even hitting a new all-time high in the November series. If, however, there's a halt and there's a hard halt here, then perhaps maybe some more time correction. The other big factor is crude, which has fallen to $75 per barrel, and it's big positive, of course, for Indian macro. So what exactly has changed over the last 4 or 5 days? The Indian market, remember, it had a just 2 or 3 day correction, but the price damage was huge. There were 3 big factors and all seem to have reversed. The biggest factor was China. It's not as if China is not getting any new money. It is, but at least in terms of the price move, the Chinese index has stopped reacting to all those new inflows. The last few days have shown perhaps the initial euphoria was a bit outdone. The second big reason, of course, has been the West Asia factor. And it looks like now a full-blown escalation perhaps is not there, and that's helped the crude price go back to $75. And the third factor, of course, was politics, where the Haryana win really revived the BJP, and that was an important factor. And the last point, the market started the series extremely overbought with 85% net long positions. That long position is now down to just 35%. So the ingredients are in place for markets to extend this move if we close above the 20-day exponential moving average.
Okay, all right. Anuj, we'll keep those levels in mind as well. Thank you very much for the context. Let's now get back to the big story, which is dissecting, of course, Reliance Industries' earnings. The numbers beat estimates on robust growth in the digital services business as well as the upstream business, which offsets a weak contribution coming in from the oil to chemicals business. Jio delivered a very strong performance as the average revenue per user jumped up by over 7%. Retail saw a bit of softness in demand in the fashion and beauty vertical. So, fairly mixed bag, but how's the sum of the parts looking? That's the question. Well, we have with us Prabal Sen, energy analyst at ICICI Securities, also Naveen Kulkarni, CIO at Axis Securities. Gentlemen, morning. Thanks for joining in. Let's start with the energy business, Prabal, and take us through, because it's mixed, right? I think oil and gas has been ahead of estimates, but oil to chemicals, if you look at the EBITDA performance there, then year on year, there's a drop. So, I mean, how do you kind of sum it up, and what is the forecast for the coming, say, 2-3 quarters?
No, I think OTC continues to be weak. This is the second quarter where we've seen a little bit of weakness, not much that Reliance can really do about the fact that the global macro itself is particularly weak. And I think that's something that's likely to continue. I was hearing the discussions around the fact that the crude is also starting to come off. The only reason that crude prices had been propped up in the last couple of weeks was the anticipation that, or the fear rather, that the Israeli-Iran conflict could develop into something much larger and engulf key transit points like the Straits of Hormuz. That doesn't seem to be happening based on the news coming out. So in any case, the crude price increase was also not really indicative of any great strength in demand. The fact that Chinese demand is not expected to really come up in a big way, based on at least the stimulus measures that they've announced as of now, is probably an additional factor that should keep refining margins and petrochemical margins on a slightly muted level from what we can understand. So from an OTC standpoint, I think the weakness will probably take a little bit, a couple of more quarters to sort of normalize. And even then, frankly, looking beyond that is very difficult given how uncertain every aspect is in terms of demand as well as geopolitics. Upstream, yes, I think the production numbers were probably a little bit ahead of estimates. There was a little bit of pricing delta, but please remember that now, once the plateau production has been hit, till the time that the next round of field development actually comes, it is likely to probably be flattish, barring the pricing delta that will come from October. From a production standpoint, I think they're close to their peak production of close to 30 MMSCMD. And now the government share of profit petroleum should also start to rise marginally because the investment multiple would have hit its milestones as per the production sharing contract. So the energy business, I think, does look a little bit under stress at this point of time. As and when it normalizes, I think it's something that we'll have to keep an eye on.
Okay, so yeah, O2C weakness expected to continue. Energy is perhaps going to stay okay. Prabal, just to talk about the new energy business, we've spoken about this in the past as well, right? Massive plans. As of now, by when are you likely to factor in some sort of an earnings sort of impact coming through? What are the timelines that you're working with now by when it starts having a P&L effect?
very clearly articulated the kind of timelines for the first wave of the factories, in terms of the production as and when it commences. But, I would imagine that over the next 6 to 9 months, as and when the milestones are hit, specifically on the solar PV module production, which I think the guidance would start from the end of this year. So, by FY26, we should have some numbers coming through, which would enable us to, start building those in earnings. But, to be on the safe side, I think a material level of contribution to earnings perhaps can be seen from FY27 onwards would be my best guess as of now. As of now, we continue to play safe and build in a multiple on capital employed in our SOTP. But I would say that, FY26, H2, FY27 is when you could probably start to see those numbers coming through in the P&L as well.
All right, Prabal, just one more question on the new energy business. How much can it add to the total profitability, say, if you're penciling in a number by FY27, FY28 as a percentage of the total consolidated PAT? Do you have a number over there that the kind of contribution we can get?
We have not published earnings estimates building in new energy, so it would be difficult for me to share a guess estimate. My apologies.
No worries. No worries. All right, Prabal, got that. Naveen, let's come across to you before we take that snappy break. I was looking at a Jefferies note, and they say in the last 5 years, when Reliance trades at these sort of multiples on an EV upon a beta basis, the last 5 years, every time it's traded around here, it's bounced off here and it's been beneficial to investors. Your take post this 14% correction that we've seen on the stock?
Yes, so if I were to look at the quarterly numbers, the O2C business was quite weak because of the global factors, as Prabal has already alluded to. The retail business was also slightly weaker. So I think things can improve from current levels, right? So at least the retail business definitely can improve from current levels. Margins, they have already got it up. The telecom business is doing quite well, right? So 2 out of 3 businesses, which almost contribute to close to around 70% of the company's value, these businesses should do better from here. From that perspective, I believe that from current levels also, valuation-wise, it's quite cheap. So fair value for Reliance, consensus expectations are in the range of around 32 to 3,300, which gives a good enough upside from current levels for a lot of people to look at, right? So considering a large cap stock with a good amount of liquidity. So it looks pretty decent at levels.
Okay. Naveen, actually, I want to understand which of the businesses will take it, perhaps drive it to that 3,300 level that you spoke of. But we do have to take a mandatory commercial break. Gentlemen, stay on. We'll come back with more questions in just a bit. Welcome back. So getting back into that conversation on Reliance Industries before the break, Naveen was telling us the stock can perhaps climb back to levels of around 3,300. So Naveen, tell us, I mean, what will perhaps drive it to those levels? Because Prabal was just indicating that O2C is unlikely to pick up meaningfully. Will it be Jio's continued performance? Because clearly the tariff hikes have been well digested by the market, right?
Yeah, so if I were to look at the tariff hikes, that I think is already getting factored into the numbers. So ARPU has jumped up by almost 195 rupees. But also important factor from Jio's perspective is that this is a very, very consistent business. And we will see consistent uptick in ARPU as they have rolled out the 5G network, right? And also people will keep upgrading to higher data packs. So that theme will continue to play out. And Jio should be able to cross an ARPU of 200 rupees in the next couple of quarters. So from that perspective, there is a consistent uptick happening in the telecom business. So EBITDA numbers for the telecom business are pretty much stacking in line with the consensus expectation. We should close this year at around 65,000 crore plus kind of an EBITDA number for the telecom business. As far as the retail business, that has been a little soft. In general, the market for retail also has been soft, except for, let's say, a few areas like jewelry aside. So that there is a lot of scope for improvement. Even in this quarter also, if I were to look at number of store additions, that were also not very, very great, right? Just from 28 net stores got added. So scope for improvement in that business is quite significant. We see that the government programs are also focusing on capacity distribution. So all these factors should help consumption boost. So next 2 to 3 quarters should be better. Of course, festival season is all upon us. So this quarter should be better and quarter 4 should also be better. So overall, from that perspective, I believe the retail business has a significant chance to pick up. So both these business put together contribute to almost 70% of Reliance Industries valuation. If they are able to do well, I think the stock will jump up. Apart from that, this was pretty much a very, very tough quarter in terms of overall results. So I think things can look slightly better from the current levels.
Okay, all right, Naveen, thank you very much for stopping by and weighing in on Reliance, making sense of the second quarter performance for us. On that note, we'll take another very quick break. We'll come back. We'll have the pre-open rates with us, and of course, we'll get you some technical trading ideas as well.
Okay, welcome back. There's, I think, a couple of minutes to go, or I think we've already hit the pre-open session on your screen now. 180 points on the Nifty and 270 on the sensex. So this is a euphoric start if we get that. I think it perhaps should moderate a little bit by the time we get to the open. But let's get our technical trading ideas out of the way. So we have Mitesh Thakkar joining us, and we have Sudarshan Sukhani with us as well. Gentlemen, good morning. Good to have both of you here. Mitesh, the question remains, would you trust yesterday's breakout out of these very short-term averages? And is there more here?
Yeah. Good morning, Prashant. I still don't believe there was a breakout. I think we are seeing continuation of the pullback which started a few days ago. The Bank Nifty has definitely gained in strength, and so has the Nifty IT. But yet, I think, we are not seeing clear signs of a strong or a starting of an up move, which could see the markets scale much higher levels. So for the timing, I think I would keep a close watch on 25, 350, 400 zones on the Nifty. Only about that we turn positive. And on the Bank Nifty, the corresponding levels would be 52, 250 to about 52, 300. Though the Bank Nifty on its own looks slightly better placed.
Okay, all right. Got that, Mitesh. Let's say hello to Sudarshan as well. Morning, Sudarshan. What's your approach? Index calls first?
Yeah, good morning. Well, yesterday I had suggested we should go long in the Nifty because there is a sense that some kind of an upswing has started. And I also explained that it is not an intraday trade because we don't know when that upswing and when that big move may come. That view continues. That upswing which started, let's say, last week has not come to an end. We don't have any signs of that. So traders should look for appropriate, say, opportunities or appropriate entry points and go long. Ideally, you want to use options so that your risk is limited by definition. But the uptrend has not come to an end. So try to enter this uptrend wherever you can.
Okay, all right. Good morning, gentlemen. Sudarshan, you go first. Tell us about the stocks you're looking at then.
Sure, it's an all-buy list. There are a number of stocks in the F&O segment which are bottoming out in the short term. Ramco Cement is a buy with a stop under 840. PEL is another buying opportunity with a stop under 1065. Hindalco, which has a decent run, has been consolidating, maybe now be willing to go up higher, is a buying opportunity with a stop under 715. And finally, TVS Motors is a buy with a stop under 2790. I must point out that none of these are intraday trades. They are all swing trades designed for a few days.
Okay, got that. Mitesh, morning. Let's come to your stock calls as well.
Good morning. I have a buy on Apollo Hospitals. Keep a stop at about 70.20. Look for targets of 72.50. Mahindra is a buy with a stop below 16.70 for targets of 17.50. Glenmark is a buy. Keep a stop at 17.96. Look for targets of 18.65. And a sell on IDFC with a stop at about 110. Look for targets of 102.
Gentlemen, good speaking with both of you, and good getting those trading ideas as well. 9:04, 4 minutes into the pre-open session, and let's just take a look at the open. 80 points, so 25,200 back on the table, back on the board once again is what we have. Let's get, let's talk about the big drop in oil prices we've seen. And Peter Maguire is now joining us, CEO at Exim Australia. Peter, good morning. Good to have you on the program as always. Thanks very much. I mean, this is, I think, a bit of reduction, a perceived reduction in geopolitical risk after that Washington Post report, news story. But do you think this will endure, Peter? What's your opinion? Demand and maybe at the margin, demand perhaps will improve with China trying to do things, but it's not been a great environment demand-wise as well. I mean, the largest private sector oil and gas company, Reliance, reported numbers yesterday here in India, both on the oil and gas side and the petrochemical side as well, downstream. They've reported slightly softish numbers. What's your sense as far as demand is concerned and the price of oil?
Well, good morning, Prashant. I mean, when you're looking at it, it's been very whipsawing and it's been incredibly tight, but also it's offered fairly good bandwidth as far as opportunity when that geopolitical premium was built in. And I feel as though it has been fairly much stripped out due to the no action in the sense of the Iran situation with Israel. So while that's backed out, it's always bubbling away that can be reignited into price very, very quickly. But the market is the market and it's down fairly well. And it's been a big correction to the downside. So that has certainly been stripped out. I hear what you're saying as far as the Reliance numbers, the China situation. There's plenty of oil. That's the first part of the journey. The second part is it'll stay at these sort of numbers if you don't see anything as far as weather outages and something to happen in the Gulf of Mexico or the Gulf of Hormuz, naturally, with geopolitical. If that was to re-engage, then prices would ratchet up quickly, as we've seen. But at the moment, it's certainly subdued and a stronger US dollar.
Hi, Peter. Great to have you on the show today. So there's obviously geopolitics on one hand and China on the other, right? And in between, we had OPEC slashing the demand forecast for this year and next year. Yeah. Now, if the Chinese do come forward and offer something to stimulate end-level consumer demand, markets will probably, take it very well. But do you expect a quick flip up in the oil markets as well because of that, if indeed China delivers?
Well, Surabhi, good morning. That's the first part. It's hard to determine because it's very, very patchy what we're hearing as far as China. There's no real examination in the sense of clarity. It's still hidden towards, from an investor's standpoint. So we've just got to wait and see how this is all going to be unwrapped over the next, say, 2 to 3 weeks. I would think by the election, the US election, you would think that China would be pretty much gloves are off and this is what we're prepared to do. The stock market has been almighty, but that's the first part of it. The second part is, yes, all of these unknown factors. I'm understanding what OPEC's doing. I'm just sitting here at the moment looking at opportunity. And at the moment, no one can be long because the market's been severely pushed down. But I think that there's probably we'll have another round of this. It'll get ratcheted back up. And maybe you've got the big hedge funds playing with it as well as far as opportunity.
Okay, all right. Peter, always good to hear your thoughts. Short but crisp discussion this morning. Looking forward to having a chat with you in the days to come.
Thank you, Noor.
Well, let's move on then. Hyundai India's big IPO. Well, that's the one that's going to be opening up today. So let's go across to Sudarshan, who's standing by to fill us in with all the subscription details and how things are shaping up. Sudarshan, over to you.
Hyundai India may be a new name for capital market, but it's a household brand that has long captured the Indian market. Once a formidable competitor to Maruti's iconic 800 with its Santro model, Hyundai has established a strong presence in India over the decades. And now it's ready to make capital market debut with the largest initial public offering in Indian history. The Hyundai India IPO of nearly 28,000 crore rupees will surpass LIC's initial share sale of rupees 21,000 crore to become the biggest ever. And the issue opens for subscription today and run till October 17. And the listing date is expected to be 22nd of October. At the top end of price band, company is likely valued at rupees 1.50 lakh crore, and this fully offer for sale issue allows promoters to offload 17.5% of equity, totaling 14.2 crore shares, reducing their stake from 100% to 82.5%. The anchor book for the IPO, which is open for bidding yesterday, has a size of 4.2 crore shares. Also, the IPO allocation includes 50% for qualified institutional buyers, 15% for non-institutional investors, and 35% for retail investors. For employees of Hyundai India, company has announced a discount of Rs 186 per share to apply in the IPO. Now let's talk about some of the internals. The earnings per share at the issue price stand at rupees 62.56 with a price to earnings ratio just above 26 times. So where do financials of the company stand in comparison to peers? On revenue front, in FY24, Hyundai India had a top line of rupees 70,000 crore against rupees 1.41 lakh crore of Maruti and rupees 1 lakh crore of Mahindra and Mahindra. On margin, it's almost at the similar level with Maruti at 13%, while M&M is leading the pack with 15%. The valuation matrix suggests that both Hyundai and Maruti have a PE of around 26 times, while M&M is slightly higher at 27.4 times. Now, talking a bit about company's details. Established in May 1996, Hyundai Motor India is part of the Korean company Hyundai Motor Group. As of June 30, 2024, it had 1,377 sales outlets and 1,561 service centers. In India, it's the second largest passenger vehicle company with a market share of 14.6%. Its vehicle lineup includes sedans, hatchbacks, SUVs, and electric vehicles with featuring models like Grand i10, i20, Venue, Creta, Alcazar, Tucson, and all-electric SUV Ioniq 5. So what do brokerages say on the IPO? Most brokerages recommend subscribing to the IPO for long-term gains, noting that while the issue appears fully priced, they anticipate healthy double-digit returns over the medium to long term. In the chat company recently had with CNBC-TV18, it said, IPO is the beginning of the next phase of the growth story. And talking about current demand, it said inquiries, bookings and retails have been strong in the month of October compared to September, with the first week of October registering a growth in the range of 30 to 35%. And on the launch front, company has a plan to launch 4 electric vehicles over next few years, with Creta EV is expected to be launched in Q4 of FY25. Lastly, if you can talk about grey market premium, we understand that the premium currently stands at around rupees 65 against a premium of more than rupees 550 that it saw in the last week of September.
Okay, well, you can catch the management speak to us about the issue as well. So it is, of course, explained and put the details out in great detail. 9:40 is when that will be coming up. So Tarun Garg of Hyundai Motor India with us then. All right, we're running into market open, 2 minutes to go. Let's revisit Reliance and what the street made of the numbers. Sonal is back with us. Sonal.
Thank you for that. Well, let me start with Jefferies, which has a buy call with a target of 3,400 rupees a share. They say B2B and store rationalization in retail with respect to margin focus will continue over the second half, and growth recovery will come back in FY26. O2C profitability because of subdued demand, something that we've been seeing across the industry. So on the back of that, they've lowered their FY26 EBITDA, but they note the sharp correction that we've seen in the stock is a good opportunity to buy. Morgan Stanley has an overweight call with a target price of 33.25. The capex intensity and debt rose on a quarter-on-quarter basis. There are cyclical challenges that they saw in the retail business as well, but that should unwind in 2025 itself. Even the refining business, which has the highest free cash flow, should unwind in 2025, and improvement should be seen from 2026. They say this will reverse the estimated downgrade cycle for these two businesses going forward. For Nomura, they also have a buy call. They say reported net debt moderated, but capex increased to 28,800 crore rupees. They've cut the EBITDA estimates by 5 to 6%, but the longer-term outlook remains constructive according to them. The consumer-facing businesses will be the reason why there will be a recovery. And the new energy business, they have given definite timelines. By the end of 2024, one phase will start. That is something which will meaningfully add and will be the key trigger in the coming years.
Sonal, thank you very much for that. So Reliance in focus, and that's the big one, reacting to earnings this morning. But the market itself, we'll start with indices and then we'll go down and look at individual names, etc. What do we have? First trades, the pre-open was indicating a 50-point higher start, and we're getting about an 80-point uptick as far as market open is concerned, 25,200 nearly. You've got the Nifty Bank, which is up 0.25%. That's 51,920. This is a pretty good start. Sensex is up about 1/3%. Midcap index is up 1/3. IT index is up 0.6%. We'll look at HCL Tech stock as well in just a bit. The Nifty heat map is coming up on your screen, and it's largely up in the green. So yeah, I mean, about what 8 odd names which are lower, but everything else is starting in the green at this point in time. Let's get to stocks Surabhi.
Okay, well, Reliance for the time being has started off a little on the weak footing, yeah, about 0.5% lower. There's ONGC, which is also down. So there's a very clear crude play with the upstream guys losing out. And if you look at BPCL, it's the top Nifty winner. So the marketing and refining companies are having a much better day. And I'm looking at the others as well. Along with BPCL, yeah, IOC and HPCL, all of these stocks up between 1 and 2%. So that's your crude play immediately. Asian Paints, again, explains what's going on. I mean, 1.5% up. So sentiment up move in a lot of the beneficiaries with the crude oil prices falling overnight. Infosys is up about 0.7%. Let's see what HCL Tech is doing because the performance was really good. About 0.5% up on HCL Tech with the guidance increase coming in at the lower end. Trent, SBI Life, Britannia, these are some of the other stocks that are contributing this morning on the upside. The market's cooling off just a little bit, about 60 points higher. Reliance is now the big drag on the way down, 1% lower. I think the retail performance is something that wouldn't go down too well with the street just because it's a little sluggish at the top line level, while Jio is firing on all cylinders. JSW Steel, Hindalco, Coal India. So these are the other stocks on the losing side. So oil and gas, commodities, metals in general, a little soft as we start the day.
Well, I think the stronger dollar is playing its role, right? There's an inverse relation between metals as well as the dollar move. So I think the stronger dollar overnight is plaguing some of those metal-related names. Let's focus on a few names. Angel One, splendid results, stock firing away, up close to around 7%. So good move is what we're seeing out there. Oil cools, as should be mentioned, you have OMCs that are doing well. And Berger Paints, that's one of the big gainers today. That's up close to around 3%. So that's doing very, very well in today's trading session. India Mart as well is up close to around 2%. So good move is what we're seeing out there. Ola Electric, I think I saw a shade of green to kickstart trade. They kickstarted the festive season on a strong note is what they've said. They've cemented their market leadership further in the EV two-wheeler space. And as of October 14th, they say that their market share is at around 34%. So the street likes that. For the time being, that's opened up with some green. Last few days, we've seen good amount of volumes on Greaves Cotton as well. That stock as well has opened up with a gain, I think, of around 2%. So good move is what we're seeing on that one. Vatek Vabag, they won a mega order of around 1,000 crores odd towards a seawater desalination plant at Indosol Solar Project in Andhra Pradesh. For the time being, that one as well, I think, has opened up higher. Vatek Vabag, let's pull up that stock. The order book now, I believe, is close to around 15,000 crores, which is super duper. So good order visibility, up 2.5%. Jain Irrigation on the losing end, that's one of the volume losers. It's down to around 62 rupees. It was around 85 rupees earlier this year. So that's seen a sharp correction. One of the stocks had bounced back and now getting sold into. So 62 rupees on Jain Irrigation as well. But otherwise, a good start.
It's a good start. 65 points. So 25,000, just under 25,200 is where we are at. The biggest volume-led gainer is Angel One with an 8% pop. So that is right there on the leaderboard. CDSL is another one, which is a close second, 3% higher and very large volume. CDSL was, of course, a big mover yesterday as well, along with BSC, which went up 7%. Let's look at BSC for a quick bit as well. Big volumes, by the way, on BSC yesterday. 0.5% on, so 48.32 there. Actually, it's all capital market plays, right? JM Financial is the number 3 biggest volume-led gainer, 5% pop, 163 on JM Financial. I can spot CAMS with a 1.5% gain. So that is at number 6 or so, but big volumes on that one for this point in the day. 361 is another capital market play, 2%. Wealth Manager, 1,085 there. But volumes here are a little lower. K Fintech, decent sized volumes. K Fintech is up about 2.5. So I think a lot of these capital market plays are doing well. What else? RK Forging is up 2. I mean, HPCL is up about 3%. We should look at IOC and BP as well. With the drop in oil, that's tends to have a reaction. Premier Explosives saw a big move yesterday, and I think it's up another 7% today. So from what Thursday's close of 248 stocks moved to about 320 in 2 sessions flat. So that's something to watch out for. Vatek Vabag, I was talking about this. The order this morning, 7% yesterday, another 3.5% this morning. And there's Walkhard Pharma, which is starting about 5% in the green as well. So 1,098 right now.
On Walkhard, I just want to mention, ever since they announced them nearing approvals for this pneumonia drug, it's an antibiotic drug for pneumonia, where they're getting approvals in India. The stock's been doing this 5% circuit yesterday and today, so the market's pretty excited about the opportunity. And on RK Forgings, UBS has initiated coverage with a buy call. They think 1,500 is possible on the stock. That's the target price, which is substantially higher. So that stock's in focus. But look at the star today, Angel One, flying away, 8% now.
Absolutely. So let's actually start our conversation with Rahul Arora, who's with us here in our studios on Angel and other capital marketplace. Rahul, of course, is CEO of Nirmal Bang Equities. Rahul, good morning. Good to have you with us here. So before we get to markets and everything else, capital marketplace, right up your alley in that sense. What's the sense, Rahul?
So first of all, morning, thank you for having me on the show, and very happy festivities to you, your team and your families. Well, on a lighter note, I declared my results to my board yesterday. So it doesn't surprise me with what's happening. I think the listed guys at least give you pre-quarter disclosures. So I think it's been a remarkable 6 months. Our business is a derivative of the mutual fund industry. The more they do, the more they churn, the better for us. It's literally as simple as that. It's all a question of, the SIP flows, really. I think the fact that they're still continuing 25,000 crores a month, you're still seeing, just look at the amount of demat accounts that were there when you went into the lockdown, compare them to what you have today. I think that number is up, 5x, 6x, something like that. So nothing is surprising here. I think, Prashant, in our business, it's purely operating leverage. So my costs move once a year, which is basically when I give my salary hikes. That's my raw material as a percentage of sales my raw material is my people. And that's true for any player in capital markets. So any incremental activity in the market basically flows straight through your bottom line. So, while I don't want to get too specific into our numbers, I think we're at a 43% ROCE for 6 months.
Wow.
So, you can just imagine theoretically, if I was to list in this market, I'd
Rahul
get a reasonable valuation
as
well. But it doesn't surprise me that, I think you're going to see the same kind of results when Kotak Bank declares. I think you'll see that in Kotak Securities, you'll see that in Motilal Oswal, Edelweiss. Angel's doing remarkably well. I think what they're doing with the digital part of the platform. So CAMS, BSE, NSE, I think in the grey market, you're seeing what's happening to the price of NSE as well. And I think in the unlisted space, it's all going on a whack.
What's happened
Swiggy.
have there been any new trend? There are no sellers on the NSE.
No, there are no sellers, and that's why, you are having the price sort of artificially jack itself up. And, somebody was telling me recently the CCPS deals of Swiggy were happening at about 350, and the grey market price is about 550. So, if that's the kind of sentiment you're dealing with, then you just want to hold on to capital marketplace. Now, the question is what valuation you want to buy them at, and then that's a question you can ask for any sector. But at this point in time, if I was a holder in any capital market-related stocks, I don't think I'd be selling them at this point in time. The times are good. Even if you do have a correction in the market, I don't see any reason why. Like I said, it's churn at the end of the day. So it's good for business one way or another.
If you're a holder, there's no problem at all in life, like in market in general, right? It's always about people who are trying to sort of, find an entry point into areas where there seems to be good business runway, but then at what price? So therefore, on capital markets, give us that number. What perhaps would be fair value in a sane world?
So, okay, let me put it this way. When HDFC Mutual Fund listed, I think for a 40% ROE, ROC, I think the peak multiple it got was about 48 times, if I'm not mistaken, on a price to earnings. If you go somewhere around 45, 48 times, because these are not very high capex intensive businesses. So you're not going to have inventory, working capital issues. You're not going to have governance related issues. It's a very straight, predictable, simple, seedha sada business. So I think in a good time, you can give it somewhere between 45 to 50 times. I think anything above that may be a little excessive, even if the markets are doing well. And if you get these stocks around 35 times, then it's a great entry point. I think an entry at around 30, 35p and exit around 50, you've more than made your money.
So that's I guess, that's on the broker side, right?
No, that would hold true for asset management. I think even insurance, I think, I think if you look at the last insurance numbers that came out on the private, on the APE side, remarkable. SBI Life was soft, but I think if you look at Max, iPru or HDFC Life, they all grew 25 to 35%. Now, of course, there's a very large ULIP component there, which is also a proxy to capital markets, if you will. Right, it's one of the reasons ICICI Pru Life has always got a slightly lower valuation than the rest, because they've always traditionally had a higher ULIP book, which is sort of, more market linked. Yeah. And that's why, because they've been a little low on protection or the conventional business, their VNB margins have not been as high as their competitors have. So, of course, that valuation gap has caught up. But even today, I think if you look at it on a price to embedded value, all these guys are trading at about 2.5 times. So I don't think anything is that expensive at this point. if you go back 3 months and you peg anything to what defense was trading 3 months back, I think the market is still cheap.
Okay.
But I think there's been a reset in those valuation as well. So would I advise fresh buying into capital marketplace? I'm not so sure, but if you're holding them, I see no reason to sell.
All right, hi Rahul, good to have you in the studio. Since defense has pulled back a little bit, and that was the big call that you all made as well, but valuation still far away from comfort levels for you all?
Well, some have approached interesting levels. I think if you look at Hindustan Aeronautics is trading at about 25, 27 times now on FY26 earnings. We're expecting about a 25-30% kind of compounded earnings growth, like in 25 and 26. 27 is too far out to call. See, the good part, Nigel, is that theoretically, if these guys don't even get a single order for the next 2 years, I think their order backlogs are still so strong. The only issue is, are these orders once executed, are they going to see offtake? Because their biggest client is the government of India. So the point I was making a little earlier about inventory and working capital, there is a bit of risk in these businesses as far as that is concerned. But I think names like BEML, which is also down to about 32, 33 times, could potentially be looked at. Data patterns, again, not a cheap stock. Obviously, it's not a public sector as the first two are. That's come down to about 40 times, I think, somewhere thereabouts from almost, 60 times. So I think some of these where we are comfortable that earnings are going to grow at 25-30%, we are selectively telling people to sort of come in and buy defense names. But it's not a blanket overweight call. It has to be very stock specific. Okay. Valuations could still reset a little bit, but I think that 25-30% fall, in some cases even 35, my mind goes back to Mazgaon. When it fell 35%, it had 2 days of 88% rally. So I think that goes back to Prashant's earlier point about capital markets, because there's so much liquidity, good quality stocks, you're not allowing them to fall in a meaningful way. So maybe if you get a good 30-35% correction,
some of these could be interesting.
Yeah, I mean, these three names I gave you, BEML, HAL and data patterns could certainly be looked at.
All right, let's quickly wind this down with the auto sector. Then we have a new IPO, Hyundai. What's the view out there? Plenty of debate, and we'll get to the management in just a bit. But your view?
Well, 14 pages of an anchor book. I think, that itself tells a story. But no, I think obviously, for people who want to play it, I think the biggest risk remains as to what happens from a flows perspective with respect to Maruti, because this is probably a like-to-like comparison. But I think Maruti has withstood so many things thrown at it. The only thing is I don't see too many launches coming up, Nigel. I think even Maruti has not announced too many launches.
Okay.
I think if anything in auto right now, we don't even want to play two-wheelers. I think the CV cycle is virtually topped out. Tractors are doing sort of okay. But I think our pecking order would be two-wheelers one. Within two-wheelers, I think Eicher is what we'd like to play in terms of premiumization. You can follow it up with tractors, M&M, and probably passenger vehicles would be third. But our tilt would still be towards Maruti as opposed to Hyundai. Like I was telling Prashant earlier, valuations in the unlisted space have gone berserk. You've seen what's happening with Swiggy and NSE. So let's see the performance of Hyundai once they live. They've done a remarkable job in India. There's no question with their product portfolio. But we'd still probably prefer a Maruti. But within autos, two-wheelers would be the preference.
Rahul, we promised to get you back, and you must come back, because I was looking forward to a full-blown consumer discussion. There's so much going on with what DMart is saying with quick commerce, what Dabur is saying.
Reliance Retail as well.
Reliance Retail. There's so much to talk about. It will call for at least another 10-15 minutes of conversation. So we'll have you back sooner rather than later. But thank you very much for this morning.
Thank you for having me.
Okay, with that, let's quickly move on and look at the next set of major earnings that came in. Of course, yesterday, HCL Tech reported a strong second quarter. Revenue beat estimates and the margin expanded 150 basis points on a sequential basis. The company also raised the lower end of its full-year guidance from 3 to 3.5%. My colleague Rima caught up with C. Vijay Kumar, CEO and Managing Director, as well as Shiv Walia, Chief Financial Officer of the company, and began by asking where the margin beat, where the beat came from this quarter, and which verticals and geographies have been performing the best. Take a look.
So overall, across the board, we found the growth picking up in the last quarter. So financial services definitely had a strong performance, adjusted for the divestment that we had. And across the board, whether it is retail CPG or tech and services, life sciences and healthcare, these were the top three verticals in addition to financial services, where we saw incremental revenue, which helped us do better than our own expectations.
CVK, you're still cautious about extrapolating the strong Q2 demand. Why is that?
Yes, I think today we just need to be a little cautious because the demand has been very volatile. Like in calendar year 2022, November, December is when we we got signals of serious weakness in the spend environment for the clients. And of course, we are remaining cognizant of the broader macro and geopolitical environment and being cautious that we don't want to extrapolate it. Obviously, we've done well. That's why we've increased the lower end of the guidance. And we need to give it some more time before taking a strong view on the overall demand environment.
But do you think the environment currently we're in is similar to November and December of 2022, which is when demand weakness crept in? Are you seeing any likeness in the environment?
No, the demand environment is significantly better than what we saw in the last quarter. But the reason that we are not extrapolating this to the future is based on the experience that we and everybody in the industry saw in 2022.
Okay. Shiv, I believe you've called out the impact of the wage hikes, the impact of the wage hikes on margins for Q3 and Q4. So can you tell us that? So with that, do you think you're likely to end closer to the lower end or the upper end of your margin guidance of 18 to 19%?
So yes, we have called out the wage hike impact is going to be 60 to 85 basis point in Q3 and maybe another 50 to 60 basis point in Q4. But Riva, in terms of, I don't think it's going to make any impact. It's part of the planned wage revision we have done, and our margin guidance are still intact, 18 to 19% quarter on quarter, year on year. I think we are confident of achieving that. But I would not like to call out low end or high end because this is a planned wage revision we have done for this year.
CVK, what's the outlook? Some more color on BFSI, because BFSI X of the divestment grew 4% on a quarter-on-quarter basis. Green shoots in BFSI is something that we've heard from across, IT players. Are you at least confident about BFSI demand sustaining going forward? What's the momentum like?
I think BFSI North America picking up is something we had called out in August itself. And now I would say that the demand is a little more broad-based in the financial services. We found very strong growth coming in from Asia Pac, which is our growth markets. Europe as well grew quite well in the last quarter. And in the US, especially insurance, definitely grew well. So I think it's a little more broad-based and we feel good. And it's really what's happening is there's a lot of modernization programs where clients were a little cautious, but with Gen AI also giving a lot of promise on what can be done in modernization, we see some of those programs really taking off.
And what's the outlook on the other sectors? Are there any spots any verticals where you're still a bit cautious?
It's really micro verticals. Maybe I think auto in some segments, like for example, Europe automotive segment is under some pressure. There are specific clients in aerospace where there is definitely some pressure. But all of this goes into manufacturing. But manufacturing demand is also accentuated by a lot of SAP migrations that you see in the traditional manufacturing companies. So that's definitely offsetting some of the demand softness and some of the challenges that we are seeing in specific clients.
Would you say the discretionary demand is back to some extent?
Sorry, what was that question?
Would you say the discretionary demand is back, to some extent? Earlier, it was all about cost optimization, efficiency.
Yeah, definitely. So this quarter, the growth was fairly balanced. If you look at our ITBS, it's grown about 1.8% sequentially. And adjusting for the divestment, it's probably closer to a 3% growth. What does this mean? I mean, maybe 2.5% growth. And this 2.5% is quite well balanced between efficiency-led programs, which we had won, which are getting ramped up in the last quarter, and incremental demand coming from a lot of existing customers, which are mostly discretionary in nature. They're largely around data and AI is the biggest theme, and compliance and programs on modernization and things like that. Those are the discretionary aspects which we are seeing pick up now.
Shiv, what's the outlook on hiring? Your net employee base contracted for the second consecutive quarter. And even on attrition, will it stay stable for the next 2 quarters, according to you?
Starting with the first question, on the hiring front, on the contraction of workforce, I think if you see if you take out the divestment-linked State Street divestment, so on a year-on-year basis, our workforce has increased by around 2.4%. And we have, last year, we hired around 12,000 freshers, despite the fact that industry hiring was muted. And as we announced in August, we have a Ascent program kicking in now, which we intend to have Gen AI-led productivity and efficiency improvements. That will help us to, I guess, gain some more productivity and utilization. As well as I think we are going to have AI-led program to reskill and train our employees. So that will also give us the leverage required to meet the demand. So we have not worked out. We do intend to hire additional maybe 2,000 freshers this year, but that's it. I guess we don't expect for the next year. We have to plan out the fresher hiring. Work out the plan on this.
CVK, is it possible to quantify what the AI or Gen AI pipeline is?
I think, I think it's kind of a misnomer to kind of look at Gen AI pipeline, because a lot of pipeline is dependent on what programs Gen AI can enable an enterprise. So, of course, the modernization, there is a lot of modernization programs which are becoming viable, and customers are focused on eliminating technical debt, where they're using Gen AI as a very important tool. So I think that pipeline is quite strong. The second aspect is to get the right leverage out of Gen AI. Data is a very important underlying ingredient. And so a lot of work on streamlining data pipelines, all of that is where we see demand. And the third element is as customers are looking at scaling Gen AI, the underlying infrastructure, whether it is the hyperscaler or private AI stack, both of them are being used in different scenarios. So I think these are the three broad elements: modernization, data and AI, and cognitive infrastructure. All the three are the manifestations of Gen AI programs.
One final question then. How are the decision-making cycles? Have we seen a pickup? And is it realistic to expect a pickup in budgets next year? Because of the interest rate cutting cycle in the US, a potential thaw once the US elections are out of the way in decision-making?
Yeah, it's a little early to call that, Rima, but given what we saw in this quarter, and if you want to remain optimistic, I think it should pick up a little bit. But at this point, we have not baked in some of that. We really are focused on executing the current demand that's on hand, and being a little bit cautious about the broader macro environment and some specific client issues. So we'll wait for this quarter before taking a call on the longer term trend.
And do you think you'll end at the lower end or the upper end of the revenue guidance based on the visibility that you have right now?
Right now, it's 3.5% to 5%. That's a range that we've given, and that translates to 0 to 2% on a quarterly run rate. So I think we're comfortable. We're not trying to be more precise than that.
Okay, the demand environment is getting better, but HCL Tech remains cautious given the macro setup. We need to take a break on that note, come back on the other side, and then the big interview of the morning. Tarun Garg of Hyundai Motor India will connect with us as the company gears up for its mega 27,800 crore rupee IPO, which opens out for subscription today.
Welcome back. Well, let's turn the spotlight on Hyundai Motor India's 27,000 crore rupee IPO, which is India's largest ever share offering. It opens today for subscription and it will close on October 17. The company has raised close to around 8,300 crore rupees from 225 anchor investors prior to the issue opening. To help us out with a few more details, we're joined by Mr. Tarun Garg, the Chief Operating Officer and whole-time director at Hyundai Motor India. Hi, Mr. Garg. Good morning, and thanks a lot for speaking to us here on CNBC-TV18. Well, before we get to the numbers and other details with regard to the company, personally, I would like to tell you that I have driven a Hyundai, and I'd owned one, and I had absolutely no problem with it. The i20 is the one that I'm talking about. It was very good. Service was top class, and happy to have experienced that. But now we need to talk about the markets, because you're going to be listing on the Indian bourses. So welcome to the Indian bourses in a few days from now. Couple of details is what I want to get out of the way. One is the royalty increased ahead of this IPO. So the markets want to know whether or not this royalty rate that you're fixed as of now, it holds for the next few years. If yes, when does it come for renewal? Point number one on royalty. And the second factor is there was a big dividend that was paid out to the parent ahead of the IPO, which was a very, very large one. How do things shape up from here on the dividend policy as well? Royalty and dividend. Please go ahead, sir.
Thank you so much. And regarding royalty, as you know, the royalty rate is 3.5%, and we believe that it is going to be there for a long time. Regarding the effect of royalty on the results, if you can see our financial year 25 quarter 1 result, which is including of the new royalty rate, and you have seen that we have managed to have a EBITDA of 13.5%. So that is one. Regarding the dividend, frankly speaking, we had not paid dividend to the parent during the COVID year. So this was also kind of an accumulated dividend. And just to bring in transparency in the whole process and to make the IPO process smooth, we decided to kind of pay the dividend before the IPO process set in. So I think on both counts, this is where we stand. And going forward, of course, once the financial year 25 is over, we'll decide based on the earnings, based on our capex requirements. We'll announce the new dividend policy, and of course, we'll keep in view the best practices in the industry while deciding the dividend policy.
Yeah, the dividend was interesting because you paid out, a very, very large sum, which is much higher than the cumulative for all the previous years. But we get your point. We'll wait by for the dividend policy. This royalty of 3.5%, when does it come up for renewal?
So it's going to be there for a long time, the same royalty, and we don't think that there is any reason for royalty to go up in the near future, unless something very, very different happens in terms of OECD guidelines or transfer pricing issue. We expect the royalty to remain at this level for a long time.
Okay, Mr. Garg, got it. So that's the royalty issue sort of settled for now. And great to have you with us on the conversation, sir. We want to take up something that always comes to people's mind, whether they're your customers, I'm sure, potential shareholders as well, which is the big fight in the SUV space, right? And we've seen the numbers. We were speaking to the Industry Association just the other day, FADA, and it's very clear that while car sales continue to be weak, it is the SUV segment that's keeping the overall passenger vehicle segment intact, right? Now, here, there is a lot of sort of fight between yourselves as Mahindra, and obviously Kia has emerged as a major competitor in the last couple of months. And, the parent owns 34-35% in Kia Motors. So the street wonders whether there's any conflict of interest. What about cannibalization? I mean, Venue is doing well, but then so are all the Kia models. What is your market share right now in SUVs compared to Kia? And how do you resolve this potential conflict of interest and cannibalization between the two companies where the parent already has a significant stake in Kia Motors?
So look, if you see our history in India for the past 26 years, HMI has always been ahead of the curve in terms of identifying trends. In fact, in 2015, when we launched the Creta, SUVs used to contribute only 13% to the overall market. And of course, things changed dramatically. Today, in the TIV, SUVs are contributing 50-52%. As far as Hyundai is concerned, we have a big range of SUVs. And January to September period, SUV percentage is at 67%, much higher than the industry. In fact, in the month of September, we touched 70%. And what is exactly happening is actually our rural markets are also contributing the same to the SUVs. The rural penetration also stands at 67%. I think this is a very clear indication how the aspirations in the rural markets have also caught up. As regards competition, look, competition has always been there in India, whether it is from Kia or anybody else. But if you see Hyundai's track record and you see our models, Creta, continues to show a double-digit growth. In fact, we are selling close to 15,000 units consistently every month. Of course, this double-digit growth in Creta this year is coming on a back of last year, which again had a double-digit growth. So absolutely, you can see that because of our strong lineage in India, because of our strong product pipeline, because of our strong brand connect, because of 8.5 million customers who have really given us love and affection in India all these years, we believe that we have all the wherewithal to tackle all kind of competition like we have done in the past.
So just to clarify the number, you said in September, 70% of your total sales are SUV, right?
Absolutely.
Yeah.
70% of our total sales for SUVs in September.
In September, got that. So I'm just trying to understand how the market share is moving and where Hyundai is vis-a-vis, say, a Mahindra and Mahindra right now or a Kia. What is the gap? Just to understand how the pecking order is placed at the moment, if you talk about total SUV sales.
So of course, in terms of market share, our SUV market share January to September stands at 17.9%, and it is we have not lost any market share versus last year. Our last year market share was also 17.9%. You have seen that we introduced the Exter last year, which received a very good response. This was a new segment which we were entering into. This year, we apart from the Creta, we have launched the Alcazar facelift, which has received some great response. Also, we have introduced dual CNG cylinder in Exter and Nios, which is again getting us some great traction and great volumes as well. So I believe that Creta is today now the third biggest brand in the Indian auto industry across categories. And of course, the segment leader in the mid SUV segment. So you can see that the volumes continue to grow and the market share continues to be stable. And our average selling price, because of this high SUV contribution, continues to go up, affecting our margins also positively.
Mr. Garg, hi, good morning. Prashant here. What is the, now of course, people would want to know what is the future plans, right, in terms of management aggression to grow this market share in the SUV segment especially, which you say has remained pretty steady. Overall market share, though, if I look at, say, 2020, FY20 to today, has come off. It stands just under about 15% or so, the share of the market. Would you want to grow in line with what the market grows? Would you want to significantly outgrow that market? I mean, what is the level of aggression that you will bring to the marketplace?
Absolutely. In fact, if you see, our current capacity is 824,000. Next year, our Pune plant kicks in with a phase 1 of capacity addition of 170,000, which will take us to 994,000. And of course, then 80,000 more in 2028, which will take us to almost 1.1 million capacity, which is a 30% addition in capacity. So we are geared up in terms of capacity to take care of both our domestic as well as export volumes. Also, if you see, the EV space is where probably, we have a lot of headroom to grow. You would have seen in our RHP that we are going to launch the Creta EV in financial year 25 Q4, which is absolutely basically next quarter itself. Creta is a very strong brand. We believe this could be a very big game changer. And then going forward, 3 more EVs in the mass and premium segments will be introduced. And not only that, we are lining up these EVs along with a very strong localization plan. So as we speak, the battery packs are being localized. We have already announced a collaboration with the local Indian partner for the LFP cell manufacturing. We are looking at power electronics, drivetrain as well. So the entire EV ecosystem is being localized. Also, we are investing in the charging infrastructure as well. So you can see that will again add to the market share along with the increase in capacities. Of course, we have a very strong product pipeline. As we have done in the past, we always look at what are the gaps available and what can we do to really fill those gaps and increase our volumes as well as market share. The second thing I like to say is that we believe in quality of growth. So volume, market share and profit. So you can see, if you see especially in the last 3 to 4 years, how our ASPs have grown, how our EBITDA margins have grown, how our return on capital employed has grown. I think that is also very, very important, and that is also an integral part of our strategy. The third point is, if you see our capacity utilization, it has consistently been more than 90% plus. And I think this is again one reason of our very, very stable and increasing returns, because we have a very good mix of 80% domestic and 20% exports, which gives us not only very precious foreign exchange, but also a dollar hedge, and also to take care of some kind of fluctuations which happen in the market. So I think this balanced approach with a big focus on SUVs, always looking for some opportunities, and of course, volume, market share and profit in tandem going together, I think this is the approach we have taken, and this is the approach we wish to take in the future as well.
If you can put it in, and that's well explained, Mr. Garg, but internally, what is the message? You have, is the message or the aim to grow a few percentage points above the industry growth? Is it to grow in line with industry growth? Just to get a sense of what the thinking is. What's the messaging?
No, look, I'm a sales guy. Absolutely, every sales guy will want to improve our market share, and we will surely want to improve our market share. And what I'm trying to tell you is that now the resources are also there.
Okay. But
in terms of capacity, in terms of electrification, in terms of a pipeline, product pipeline, so everything is going for us.
No, sir, if I could come in over there and add to what Prashant is trying to, I think, get at, is that in general, there is a concern, despite all the the SUV boom that we've discussed. In general, if you look at the category, auto sales, in the PV segment, they've slowed down to mid-single digits, right? If we look at June numbers, Hyundai's June numbers, you're at around 5% growth in terms of revenue. So, I mean, what can one expect? Is that going to get better, or is this the new normal, so to speak, post-COVID, which is probably not a very hot number that the market is looking at, and probably the market would want more? So, at an industry level, what would be the revenue growth estimate, and how much more, higher than an industry, can you do?
Look, this is very important, and if you see, I have spent now more than 3 decades in the Indian auto industry. If you see CAGR, 5-year or 10-year CAGR, it is at 5%. Of course, post-COVID, because of the pent-up demand, in 22 we grew by more than 22%. Then we grew by more than 8 to 9%. So some kind of moderation had to happen. I don't think anybody should be surprised with that. The other thing is, if you're talking about June, July, August, September periods, because of heat waves and because of floods, etc., these are normally slow months. October, I think after a long time, both the festivals, Navratra, Dashera, as well as Dhanteras, is in the same festival. As far as HMI is concerned, we are seeing a 29% increase in Vahan registrations in the first 2 weeks over last month. So already we are seeing very, very positive offshoots. The festival has started on a bang. So I don't think we should be really worried by 2-3 months of a moderate growth or degrowth.
But you're saying 5%,
this has happened so many times in the past.
But sir, what you said, that's a big statement, right? And that's very important context. You're saying that if you go back to pre-COVID, then on a 5-year basis or even a 10-year basis, the steady state growth rate has been 5%. So are we back to that? I mean, was that the original normal and we are back there and we should be satisfied with 5% growth?
Look, what I am saying is the CAGR has been 5% on a 5-year or a 10-year period. CRISIL has said that the next 5-year CAGR could be in the range of 4.5% to 6%. I think this is what the data is saying. Okay. And I think this is not bad, Sometimes we feel that probably 20% is a norm. Please understand, this year also we are growing on a very high base. In fact, as an industry, in 22 itself, we had reached the pre-COVID levels, whereas many countries in the world were still struggling to reach that level. So I think we have to see the base effect as well.
Okay, all right, Mr. Garg, let's focus on...
The second important point, I think, which...
Yeah, go ahead, sir. Please complete that point.
Sorry, but the second important point here is the premiumization, because one is the volumes, the second is the average selling price, and the premiumization which is happening, the SUV percentage which continues to go up, the higher trims which are being sold. I think that aspect also has to be taken into account, because this is the new Bharat we are talking about, where aspiration has taken over functionality, and people are wanting to take higher trims, they want connected cars, they want sunroofs. So average selling price is going up. So the revenues are growing at a much faster rate than the volumes. I think that is also a very important aspect which we must keep in mind.
All right. The premiumization play as well. Mr. Garg, you briefly mentioned on a couple of aspects. Exports. Exports are in early 20s, I understand, as a percentage of your total mix. And exports, I presume they're better margin business. So that's what will help your margins as well. Give us 2 numbers. What does export stabilize at as a percentage of the mix? And also I was looking at, raw material imports. I think that as well is in early 20%. What is the plan on that front? Do you look at reducing that dependency?
Yeah. So if you see our export in terms of volumes are contributing about 20% to our sales. In terms of revenue are contributing 23% of the sales.
Yes.
So India is a production hub for emerging markets. We're exporting to 80 plus countries, including Middle East, Latin America, Central America, Asia, Africa, etc. In fact, right from the time we set foot in India, exports has been an integral part of our strategy. You talked about foreign exchange. Yes, dollars, the export currency is dollars. And of course, we, government also incentivize a lot on exports. So we get incentives of 3 to 4%, which helps us in the margin on exports. On the localization, our current localization is at 80%. Absolutely, we want to really increase the localization. If you see, the major part of imports is on the semiconductors. We believe that now there's a big plan of localizing of semiconductors as well as government is concerned. They are really encouraging more and more companies to set up units in India. So we are looking at it with interest, and as and when opportunity comes, we will look at increasing the localization content, because localization is very important, not only from a cost perspective, but also from a geopolitical point of view, because it helps us in taking care of the logistics and other issues as well. So very, very important for us to continue to work on the localization.
Got it. All right. So localization is one point that you'll work on as well. You've raised an ambitious plan for the next few years. I think 30,000 crores of capex. So how do you fund this though? Give us a near-term target. In the next 3 to 5 years, what should be the total capex plan that you're looking at? And what about funding? Because some part of the market fears you'll have to come back to the market to raise some capital.
So if you see, we have announced in our RHP that we are going to invest a total of 32,000 crores by 2032.
Yes.
32,000 crores by 2032. So it's a staggered capex. Of course, it includes the Pune plant, it includes new models, it includes everything. And we believe that we are generating enough cash and enough internal accruals to take care of these capex needs in the next 8 to 10 years, which I've said. So this is where we stand today.
Mr. Garg, just a broad sort of industry question, but very relevant to you as well. What do you think? I mean, demand and that is fine. Electrification, of course, is a theme which will continue to pick up, and we'll see the pace of adoption, etc. But what is the for Indian automakers? Is Chinese competition a big risk as we go down that electrification path? I mean, BYD, for example. I mean, some of the Chinese players. I mean, it's not a big. There's no big level of competition here in India from them currently. But what's your sense? Because you would have a bird's eye view about, technology, level of products, and things like that. Go on, sir.
So look, if you see the history of India, and of course currently India is at the early stage of electrification. Current penetration is at 2.5%, backed by government incentives. I think electrification is only going to go up. You mentioned about Chinese OEMs or European OEMs or US OEMs or any other OEMs. Frankly, competition has always been there. What is more important is what is the company's strategy? What is the company's connect with India? How are you looking at really converting your customers, upgrading them to electric vehicles? So we believe the kind of game plan we have in terms of launching those 4 products led by Creta EV, localization, the charging infrastructure, and the strong brand connect which we have in India. We believe we are rightly poised, of course backed by very strong HMC parentage. It really helps us to get all kinds of technologies in India. And I'm so encouraged, actually, frankly speaking, by yesterday's anchor response that we have received. 225 individual lines, from FIIs, from sovereign funds like GIC, Norges, Fidelity, Schroders, BlackRock, and of course so many domestic institutional investors like SBI Mutual Fund, HDFC, Axis. I think that really shows that what kind of confidence everybody has in the proposition of which we have to offer.
And they'll hold you to it as well, Mr. Garg. But it's a good conversation, and I think it's a good way to kick off the listed journey. But I think, Surabhi, you have a question?
One last question, sir, if I could squeeze that in. And I'm just speaking, out of the concerns. So it's a very well-loved brand, and that explains the anchor book as well. But just one last question, that the parent is selling a little over 17% right now, and regulatory setup and rules will require the parent to offload a little more equity to come down to this 75% minimum public shareholding requirement, right? Aside of that, I mean, will the company need to raise any further equity capital? Because none of the money that's being raised now, this massive 27,800 crores, none of that is going to the company. It's going to the parent, right? But for your funding needs to, keep propelling the India story forward, will the company need to come to the market again to raise fresh equity? Because very heavy paper supply, that is one concern in the market as well. So if you could just address that.
Look, I think our record speaks for ourselves. We have a very good record of cash conversion and generating enough internal accruals. So we believe that we are adequately financed to take care of all our capex needs, in the near to midterm future. As regards the balance 7.5%, which we have to do, of course, 3 to 5 years is what the regulators require us to do, and we will definitely follow that. So, I mean, as things stand right now, we believe that we are adequately, self-sufficient to take care of our capex needs.
All right.
And to grow, continue to grow on a good path. Yes.
Well, Mr. Garg, we thank you for joining in and clarifying all those aspects with regard to dividend, royalty, how you see the market shape up. And as you said, premiumization is something that will help you in terms of growth as well in the coming years. We appreciate you joining in. Looking forward to having a chat with you, though, on the IPO listing. Until then, we'll wait by to see the response. Thanks a lot for joining in. Well, let's move on and let's focus on the markets then. As we're having that conversation with Hyundai, just take a look at what happened to the markets. We're now down close to around 60 points. When we started that conversation, we were up 40, 50 points or so. There is some nervousness that's actually crept into the Asian markets on the whole, and most of them have moved to the low point of the day as we speak. Nifty is still holding about the 25,000 odd mark, but there is some selling that's crept in, and we have given up close to around 50% of yesterday's gains. Mitesh Thakkar is back with us. Hi, Mitesh. Welcome back. It's 10 a.m. So give us your call on the index first, as well as a couple of fresh picks.
Morning again, Nigel. As I said, this is not a market which is breaking out, still contracting, still consolidating. I think we are kind of now tapering off from the upper end, which is first level is around 25,250, and then we have 25,350, 400 zone. So I think we still might just do this range for some time, and therefore I think trading with the stock specific bias is what I feel would be a better approach in this kind of market. I have one sell, and today a lot of your metal names are breaking down. So Jindal Steel is a sell with a stop at about 990. Sorry, look for a target of around 945 here. And that apart, I have a buy on Oberoi Realty. Had a good breakout yesterday, is giving mild pullback today. So around 1975, 1970, I think that's a good area to get in. Buy there with a stop at 1945 for targets of 2030.
Okay, all right, Mitesh, thanks very much for that. So markets off about 70 points on the day, 25,060 is where we are at. We'll take a break. We are back with commodities and what's making news. Manisha is going to be with us on the other side. Stay with us.
Welcome back. Well, we'll soon start, I think, showing you some visuals which are coming in from the India Mobile Congress 2024, which is underway in New Delhi. There you go. Industry bigwigs and the leaders of the segment. Akash Ambani, chairman of Reliance Jio Infocom, Kumar Mangalam Birla, chairman of the Aditya Birla Group, Sunil Bharti Mittal, chairman of Bharti Enterprises, all of them there. I think this was just before they went in for the inaugural session. Promises to be a big event where, of course, there's lots up for discussion, including the rollout of 5G and other newer technologies, and plenty of course, interactivity expected with government dignitaries and the minister himself. All right, we'll keep getting you updates from the India Mobile Congress as it gets underway. But for now, we'll shift focus to the commodity segment. We have Manisha joining in. Manisha, what do you have your eye on?
Well, I'm looking at the energy as a market because while the crude oil prices have been declining, that's exactly what you have seen across crude products as well. So starting with the energy markets itself, and the Brent prices fell 2.5% overnight. And as you can see, we are 3% down in the Asian markets right now as well. So 75 just about holding. It was just previous week that we saw 80 plus kind of levels come in for the Brent prices also. So this has been a sharp decline in last couple of sessions already. Well, reasons are that the OPEC has cut the world demand forecast for for a third straight month. And this time around, the OPEC and allies feel that for 2024, the growth demand that you will see in this year would be to the tune of 1.93 million barrels per day. And next year would be lower at around 1.7 million barrels per day, 1.65 million barrels per day. So we have seen a constant decline come in for this one. Apart from that, the China crude imports have continued to decline as well. From the month of Jan to September, the overall imports have declined by 3%. And also the China markets have seen a decline also because of the lack of new stimulus measures, which the street was anticipating to come in by this weekend there. China's shifting from diesel to LNG and EV has been yet another reason that you are looking at weaker demand coming in from one of the world's largest importers and consumers as well. Well, there also are oversupply concerns in the global markets because you're looking at higher production coming from US. The spare capacity with OPEC and allies is higher than 5 million barrels per day. That continues to weigh in as well. And then there has been statement from Israel saying that as they strike Iran, it would be on Iran military and not nuclear or oil facilities. So that fear about disruption in oil facilities also seems to be going away. So that bit of a war or geopolitical premium is coming off the markets. There is weightages that we have seen come in from the dollar index as well, which is holding above 103, which is a 10-week highs. So not just crude oil prices, but if you look at the metal market today, copper, aluminum, zinc are trading on a weaker side. Gold and silver is in the negative as well. So the strength in US dollar index also seems to be weighing on. And then not just crude, if you look at natural gas, that's down by 5.8%. Heating oil fell nearly 5% in the overnight markets as well. Now going forward, it is going to be important on what the speculators also seem to be doing. At these lower levels in the previous week, we have seen net long positions being added for a fourth straight week. The shorts have been continued to be cut, which is at the lowest, by the way, now since 2016. So there is that balancing that we are seeing in the international markets also. But going forward, there's so much to watch out for. Today, you have the IEA data coming in sense of global demand and supply numbers. Tomorrow would be the crude inventories. And then as you get into the month of November, the US Fed meeting, presidential elections, and all of that would continue to impact crude and vice versa. So it's going to be a volatile month going forward for crude prices.
All right, Manisha, thank you very much for that. So oil very much in focus, but thankfully not on the boil. Now, let's talk about JSW Infrastructure. Vivek is here to tell us what's happening. Vivek, morning.
Well, good morning. Very interesting report from Nuvama today. They've initiated coverage on the stock. They have a target price of close to 390 rupees a share. In terms of earnings, they expect the revenue, EBITDA, PAT, CAGR to clock almost 19%, 16% and 15% respectively from FY24 to FY27. And they've come to the target price by giving a valuation of close to 25 times FY28 EV to EBITDA. Now, about JSW Infra, what is it that they're saying? Second largest private port company with a 25% volume CAGR that the company has seen over the last 5 years. They say that the company is poised to sustain long-term growth on the back of favorable macro tailwinds. What they're expecting is that they're expecting almost 4 times capacity growth over the next 25 years, supported by both organic as well as inorganic growth. Organic growth is coming in from the group companies itself, especially JSW Steel. Inorganic growth that the company has already done in terms of acquisitions, both from ports as well as the logistics segments. They believe the JSW group may continue to contribute almost 50 to 55% of the revenues over the long term. And they see, as far as FY28-29 is concerned, they are expecting almost 43% and 25% year-on-year growth respectively as far as EBITDA is concerned. Along with that, they see key triggers or key kickers as the commissioning of the Jaigarh port, the Dharampur port, the Goa port, as well as the Greenfield Jatadhar port, as well as multiple slurry pipeline projects that the company has in its kitty.
Okay, all right, got that. Thanks very much for it, Vivek. With that, let's take I think we have, in fact, before we take that break, we have Sonal joining in. Suntec Realty came out with updates as well. So let's look at those numbers. Sonal?
Well, it was a good set, and it has come in at a time when the other players have seen a YOY decline. But Suntec, on the other hand, has seen an improvement on a YOY basis in pre-sales. So pre-sales, they went up by 33%. The collections have also gone higher by 25%. However, there has been a decline here on a sequential basis. On the first half basis as well, sales are up 31% to come at 1,026 crore rupees, and collections, they've gone up by 21% to come in at 609 crore rupees. Remember, this comes in after quarters of decline that this company has been seeing. So definite improvement, and that's why the excitement on the stock today.
All right. Thanks very much, Sonal, for that. We take a break. On the other side, our special segment, it's the economy. Lata will be speaking with Shashadri Sen of MK Global. And they'll talk about the weakish kind of macro environment that we find ourselves in and whether it'll impact second quarter earnings. By the way, some visuals coming in from the Mobile Congress in Delhi. Prime Minister Narendra Modi sort of being shown around the venue and through some of the stalls as well at the IMC 2024 event. You earlier had visuals of Akash Ambani and other dignitaries there at the event as well. So we'll, of course, get you updates from there. I think there'll be a couple of interesting speeches that we'll bring portions of to you as we go on. All right, we'll take a break. It's the economy on the other side.
This isn't an economy story as much as a corporate earnings analysis. Now, macro trends for the second quarter have been weak. IIP, core sector, both contracted in August. PMI came in at an 8-month low in the month of September. And most tellingly, GST collections in September were only 6% higher year on year against a nominal GDP growth forecast for the current year at 10 to 11%. To what extent will these macros reflect in the Q2 earnings? I have with me Seshadri Sen, the head of research and strategy from Emkay Global. Seshadri, good morning and thank you very much indeed for joining us. Well, for starters, yes, we've had two biggies who have already announced numbers and a few smaller ones. But how bad is the second quarter likely to be in terms of overall Nifty earnings?
Hi, Lata. Thanks for hosting me on the show. It's good to be back to talking to you. If you look at the aggregate numbers, they aren't particularly inspiring, very frankly. There's flat top line and I think even flat bottom line. But once you dig deeper, the forecasts from our team and consensus don't look that worrying at this point in time. The stresses, I think, is focused on two sectors. One is the energy sector, where there is a high base effect. And this is the last quarter of the base effect. Cement, this is a seasonally weak quarter, and this time the seasonality has been a little more pronounced than normal, which is why cement is dragging the overall Nifty and from the MK coverage universe as well down further. If you strip these two out, our coverage universe is showing about high single digit, 7% top line and 12% bottom line, which is reasonably healthy. And Nifty's, again, if you strip out these two sectors, is also showing fairly similar earnings growth. So we don't think that this will reflect majorly on the quarterly earnings. However, if this continues, then the commentary will get affected and that could be an overhang.
Let me come to the however in just a bit. What is at the moment the full year forecast? Is Q2 a one-off and full year going to be a good middle single mid-teens, high teens kind of growth in earnings?
Yes, I think for FY25, we are still looking at a low to mid-teen. High teens is unlikely, low to mid-teen earnings growth as far as the Nifty is concerned.
Okay.
And there's nothing in these Q2 numbers which disturbs that trend. Okay. And if you analyze the Nifty EPS forecasts, they've actually been rock solid over the last 6-8 months. So I don't think that there is a risk. FY26 would, however, may be a different story, especially if there are rate cuts and banks start showing some stress.
No, fair point. Let's not venture into FY26 simply because we still have a November 5th event to tide over, and that might change the world, the global jigsaw. But let's get sector specific. Which would be the sectors you would worry about in the Q2 itself?
As I said, cement is expected to show weak earnings. That's the only sector where we are seeing, as a sector, we are seeing worries. Though I would argue that is known in the price. I'm not sure that it'll promote a sell-off. But as far as earnings is concerned, that's one sector which we are looking at a reasonably soft quarter. That is probably the only one. Oil and gas, obviously, energy is the other one where we are expecting year-on-year growth numbers.
Which you said that energy is actually impacted by the high base. You said that. Let me come to the stronger sectors then. Consumer is again a little troubled. The DMart numbers didn't look good. And of course, you could blame it on quick commerce, but overall the numbers were not very encouraging. As well, if you looked at the GST numbers, GST is a consumption index. That didn't look very good in September. IIP numbers, consumer non-durables didn't look good. So would you worry about consumer staples generally, FMCG?
No. I think there is a shift in the consumer sector in FY25, and we are going to see signs of that in the second quarter results. There is a significant slowdown in discretionary consumption. So all areas of discretionary consumption, which are not staples, which are which show some kind of top line stress, and you will see that coming through. Those are however, some of those companies are fairly small, but I would keep an eye out on discretionary consumption. Staples, and what is happening this year is that the momentum is shifting away from discretionary to staples. Staples, after a fairly torrid 2-3 years post-COVID, is starting to show signs of recovery. So I think, some of the positive surprises could come in the staples sector, where we will see both top line and bottom line momentum. Retailers may not be the best way to look at it, but the companies themselves could show signs of recovery.
Okay.
So we are actually, quite the opposite of what you're saying. We are quite constructive, in terms of how staples will report. The sectors also rallied. Okay. So,
but you're clearly super optimistic on consumer discretionaries.
No, I'm a little cautious on consumer discretionary and a little optimistic on consumer staples. I'm not super optimistic in this environment on anything because we're dealing with a fairly high base on consumption of 3 years of momentum. So one has to factor that in when one calibrates expectations.
Okay. Where is your area of comfort in terms of earnings? As in, where would you be optimistic at all?
See, I think industrials, auto ancillaries would all show reasonably strong earnings. Now, as I pointed out in my last note, that's some of that is in the price. But in terms of earning momentum, I think that is where, industrials especially would continue to show. There has been a bit of a blip in the first quarter, in the first half, because government capex has slowed because of the elections and other factors. And maybe some of that is reflecting in the macro numbers that you just were referring to. But having said that, I think industrials will still show fairly strong earnings.
Okay.
Whether these valuations justify those earnings is a different debate, but earnings-wise, that should be one sector.
No, I'm coming to the prices in just a minute. It's just that they change so radically. But let me stick with performance. If for the full year, you said that, low to mid-teens growth is what you're fixing for the Nifty. What about the broader universe?
A broader universe is tough to make, beyond, say, Nifty, it is really tough for it to make a forecast for any index because as you go deeper, the extent of coverage for some of these sectors are not that strong. So what we do is look at a disaggregated analysis of the top 350 companies by coverage. And there, if you look at the broken down numbers, around 65% of the companies have their earnings in the range of +10 to -5, right? Which we call as stable. So our the key conclusion from that is that broad earnings forecasts and at a disaggregated level look very stable. They've been more stable than they have for the last 2 years.
That's good news.
And that gives us comfort because aggregate numbers, are moving parts. One large company shows a drop off and it can get quite misleading.
Yeah, I take your point. I take your point on that. So let me come straight away to both putting price and valuations, putting earnings and valuation together and the current price trends. Where is MK overweight?
So we are overweight on consumer discretionary, which may seem a bit odd given what I said, but there we find autos fairly constructive. We continue to like healthcare. Those are our two main overweight sectors as far as, at this point in time.
Okay.
We are, as I said, a little cautious on the markets overall. So we aren't, bullish on too many sectors at this point. Energy is the third sector that we like.
Okay. We'll leave it at that, Sheshadri. It was a pleasure speaking with you. Thank you very much for preparing us for the oncoming earnings season, though, of course, a couple of biggies have already reported. Thank you very much for joining us in this discussion. Well, that's it on Bazaar. After a break, Chartbusters.